Thank you for joining us today. My name is Rhonda McGill, and I'm the Senior Director of Client Success here at PerformLine. On behalf of the PerformLine team, I want to welcome each of you along with our wonderful guests who will be introducing themselves here in a moment. In the first half of 2023, there were over 100 enforcement actions taken against financial services organizations from federal, state, and local regulators. As we prepare to wrap up the second half of the year, we wanted to pause and take a look at a few notable violations that touched on compliance with marketing to customers. Today, we will take a look at a few notable enforcement actions and discuss some trends. We will touch on some of the expectations from regulators that you may want to be prepared for, and we will also share some best practices that you can do to be proactive with your marketing compliance, keeping your business out of regulatory trouble. Joining us today are Kimberly Holzel and Courtney Hayden of Goodwin Proctor. Kimberly and Courtney, please tell our guests a little bit about yourselves and your area of practice at your firm. Courtney, would you like to go first?
Happy to. Thanks for having us. My name is Courtney Hayden. I'm counsel in Goodwin's Boston office in our consumer financial services litigation practice area. I primarily represent financial institutions and fintech companies in government investigations, enforcement matters, and complex litigation, including class actions.
Thank you. And Kim?
Hi, everyone. My name is Kim Holzel. I'm a partner at Goodwin Proctor in our Boston office, where Courtney focuses on enforcement and litigation. I'm on our business law and compliance side. I represent fintech companies, banks, and their investors in building financial services and making sure that the programs run in compliance with the law so that hopefully there never is an enforcement action.
And Kimberly and I had an opportunity to work together about a year and a half ago, hosting a roundtable to discuss buy now and pay later. So it's so good to have you back with us here at PerformLine. So let's jump into some of the notable enforcement actions around marketing and advertising. I think maybe first, let's talk a little bit about the mortgage space and redlining. So maybe it's just me, but it seems like the DOJ has been very focused on redlining. Courtney, would you mind providing a bit of background and overview on some recent redlining cases for our guests?
Sure, happy to do so. I thought it would also be helpful to give a little bit of context in terms of where these cases are actually coming from and why. So as you mentioned, mortgage fair lending cases in particular has been a large focus and continues to be a large focus of both state and federal regulators. We have a firm blog that tracks enforcement data, and through that we've seen that there's a decrease, generally speaking, in overall mortgage origination and servicing related enforcement actions in the past couple of years in 2021 and 2022, but we're actually starting to see an uptick and a rise in that area in 2023. It's our view that this is not surprising because the Consumer Financial Protection Bureau, or CFPB, had issued a fall 2022 supervisory highlights that suggested that more enforcement actions in the mortgage space were going to be forthcoming. And in the mortgage fair lending space in particular, the Bureau fairly recently had issued summer 2023 supervisory highlights, and these indicated that recent examiners had found alleged violations of the ACOA, its implementing regulation Reg B, and that it's also going to be focusing on potential violations of HMDA and Reg C for the remainder of the year and presumably years to come. So with that kind of context in mind, I'll mention a couple of recent mortgage redlining enforcement matters. So in February of this year, the DOJ had announced a $9 million agreement to resolve allegations in the Southern District of Ohio that a lender had engaged in, quote, a pattern or practice of lending discrimination by redlining in the Columbus, Ohio metropolitan area. This was part of the DOJ's, quote, combating redlining initiative, which was started and announced by the DOJ back in October of 2021, so almost 2 years ago at this point. The DOJ alleged that this particular lender had failed to provide mortgage lending services to majority Black and majority Hispanic communities. This lender had concentrated all of its branches and lenders in majority white neighborhoods. The DOJ found that the peer lenders had generated mortgage applications at rates 5 to 10 times higher than this particular lender in majority Black and Hispanic communities. And then peer lenders had separately offered mortgage loans at rates 4.5 to 12.5 times larger or higher rather than this particular lender. And so some of the specifics of the consent agreement is fairly similar to what you'll hear from me with respect to the next redlining action that I'll mention too, but it required an investment in a loan subsidy fund, money to outreach, advertising, financial education in minority neighborhoods and communities, and development of community partnerships. It also required the company to open new branch and loan production offices in majority minority neighborhoods too. Kind of, if I can just jump to the next tag along matter.
Yeah,
okay, and then we'll do some takeaways at the end here.
Okay.
So a couple of months later in May of 2023, also as a part of the DOJ's combating redlining initiative, they had brought a separate enforcement action that resulted in a settlement that had kind of an added marketing heavy focus to it. So a community bank was sued by the DOJ over claims that it had also engaged in a pattern or practice of lending discrimination by redlining in Black and Hispanic neighborhoods around the Philadelphia area. It alleged that the bank had excluded a specific Pennsylvania county from its I'm completely blanking.
Reinvestment.
Thank you. Community reinvestment assessment area, which is commonly referred to as the CRA. The claims that it asserted, pretty similar, Fair Housing Act claims, ACOA claims, which is pretty repetitive in this area. And actually, I'll mention like an interesting procedural nugget of how the DOJ got this case, which is how the DOJ sometimes does get matters. So this was initiated by an FDIC examination, and the FDIC had referred this case to the DOJ, and that's fairly not necessarily common, but it does happen. Technically, there's a requirement that certain agencies, when they've identified a potential pattern or practice discrimination claim, they must refer such cases to the DOJ for the DOJ to potentially do its own investigation and decide whether it wants to pursue an enforcement matter. So that's how this case got to the DOJ. So kind of the marketing focus here was that DOJ alleged targeted marketing efforts had occurred in majority white areas, but not minority areas. And then one additional interesting fact here that the DOJ focused on was that the company had ascertained fair lending reports from third-party vendors, and those vendors that the community bank had engaged actually identified these as potential issues, and then the DOJ found that the bank didn't actually address them in any meaningful way. So the consent order ended up being a $3.2 million consent order here with the same types of financial requirements, providing money to a loan subsidy fund, investing in community partnerships, and then hiring designated loan officers to serve minority communities. So happy to talk about some takeaways on the kind of more I guess like low level front, and then Kim, maybe you can provide some higher level risk management ones. Absolutely. I would just say that, from these two enforcement actions, it's important to make sure you're reviewing your own data, reviewing peer lender data if possible, especially to understand mortgage application and origination volumes separately between minority and non-minorities. Monitor locations of loan officers and brokers and branch locations, and pay attention to what vendors are telling you, and perhaps if you're not going to implement identified issues, consider documenting that and documenting the reasoning why. So Kim, I'm not sure if you have any other risk issues you'd like to discuss.
Yeah, I mean, I think at a very high level, there's been longstanding FFIEC fair lending guidance for a long time, so it's always important to continue to adhere to that. However, I do think everything that Courtney mentioned represents a pretty big shift in the DOJ and CFPB's enforcement priorities to redlining specifically. And in some of their more recent actions, you can tell that they're focused on some specific metropolitan areas in particular. So if that's an area that you do lend in or lend near and should be lending in, then those are perhaps some metro areas to consider doing more targeted analysis with your redlining fair lending program. In addition, we've had some learnings that even if you're not lending in a particular area, if your peer lenders are lending there, the CFPB doesn't necessarily see it as an excuse that it would be difficult to break into that area where there is mortgage need. So certainly there are business considerations in expanding into any new area, but we found that the CFPB has been unsympathetic, as well as the DOJ has been unsympathetic to the fact that that market may be saturated by other lenders who have a market capture in those areas. So that's all I have to add. One other point that I wanted to make is that, the CFPB and the DOJ are not necessarily limiting their redlining enforcement to mortgages. We're starting to see some inquiries into other financial service products. And so, for example, if you're a bank that offers a credit card program, it's still important to make sure that you're advertising and offering the service throughout your footprint, and making sure that your footprint is fair from a redlining perspective.
And I think it's easy for people to overlook outside of the mortgage space because everybody thinks of redlining as in neighborhoods and in city blocks. So thank you so much for bringing that up. I think it's really important for other areas in the financial services to be really attentive at making sure that they are not creating the imaginary redlining with the way that they're advertising their products. And Courtney, a few moments ago, you were talking a little bit about some of the how the FDIC was a part of that referral process over to the DOJ in the redlining instance. But it seems like the FDIC has been really active too, as it applies to how people are representing and utilizing the FDIC title specifically. I've seen a lot in the crypto space. Could you talk a little bit about some things that are going on in that space? Because I think it's, it's an emerging space and it's continuing to have some nuances that, folks are just not sure about. So I'd love to hear your wisdom on that.
Sure, absolutely. So the matter that I was going to discuss, I realized just yesterday that there was basically a duplicative one that came out just a couple of weeks ago that I'll touch on too. So back in February of this year also, the FDIC had issued letters demanding that two companies, one was a cryptocurrency exchange and the separate entity was a non-bank financial servicer provider, demanding that they cease and desist from making alleged false and misleading statements about FDIC deposit insurance. Separately, the FDIC had also directed two websites of separate companies to remove similar alleged false and misleading statements about the nature of FDIC insured status of that cryptocurrency exchange. The FDIC alleged that the entities had stated that they were FDIC insured when they actually were not. The FDIC Act prohibits anyone from representing that an uninsured product is FDIC insured or misrepresenting the extent of deposit insurance. And the FDIC here claimed that the companies had misused also the FDIC name or logo, kind of in furtherance of that alleged misrepresentation. And then what I was just alluding to at the very beginning here was that just 2 weeks ago, the FDIC made a very similar demand against another crypto non-bank. So we continue to see them pretty active, as you mentioned, in the crypto space with these demand letters in particular.
It just seems like it's not going away. So it's the monitoring, especially for the companies themselves, just the importance of that monitoring. And Kim, if you could talk a little bit more about some of the things that some of these companies can do, because things may not always be intentional, but it's just that extra step of making sure that the monitoring is occurring and that the compliance measurements are in place.
Yeah, oftentimes it's not intentional at all. And we see these programs set up in such a way that they just don't qualify for FDIC insurance because the requirements were not met. And they're not particularly difficult requirements, but they're things that, kind of get overlooked. And that's what generates a lot of these actions. So obviously only a bank can be a member bank of the FDIC. And so, first and foremost, non-banks and crypto companies, they can't really represent that they are FDIC insured or that any funds that they hold are FDIC insured unless those funds are actually held perhaps in a custodial manner at an FDIC insured bank where it's set up in such a way that that insurance would pass through the non-bank's account to the people who actually own the funds. And so we see a lot of this in these bank fintech partnerships these days, where a fintech wants to offer an account or a payment product or a debit card to consumers. They want to be FDIC insured. And that's all fine and good. That's definitely possible. But what you need to do is the bank or the non-bank, if they're appropriately licensed, needs to set up an account at the bank that's either going to be titled in the name of the insured depositor, their customer, or what's more common is you don't even have individual accounts, but you have some sort of omnibus pooled account, and that's either going to be held in the name of the bank or in the name of the fintech if they're actually licensed to hold that money. Now, the problem with that is that, the titled account owner would typically be the depositor who's insured, and that insurance is $250,000 per person per bank. So if you've got the name of the fintech company on that account and they're holding money for other people, each person is not insured for $250,000 unless you can meet the additional requirements for pass-through insurance. So in order to get pass-through insurance, the titling on the account has to show that that money is being held either by the bank or by the fintech company in a custodial manner for the benefit of these individual beneficiary customers. And then there has to be record keeping that's either done by the bank or adopted by the bank, even if it's done by the tech company, which shows exactly who owns what money in that account and who the beneficiaries are and in what amount. And if all those requirements are met, then the individual depositors would typically be eligible for deposit insurance on a pass-through basis, even though they don't have an individual account at the bank or at the tech company. So those formalities, they're not typically a big deal, but they are things that can just be done incorrectly, and it entirely makes your customers ineligible for FDIC insurance. And then if you misrepresent the insurance status, that's when the FDIC can pursue enforcement on that. And then the one additional thing I'll say about this is there's been a rise in these deposit sweep programs after the failures of Silicon Valley Bank and others. And the reason for that is because as we saw, so many big companies were at risk of losing a lot of their money because the FDIC insurance only goes up to $250,000 per person per bank. Mm-hmm. And it's just not realistic for a lot of companies to hold 250 here, 250 there, and have all these different operating accounts. It's just not feasible. So where that left a lot of people when we were waiting over the weekend for the FDIC to say something about Silicon Valley Bank is all these depositors thought they were going to lose everything over 250 that was at SVB. So after that happened, we saw huge explosions in sweep accounts. And what a sweep program is, for those of you who don't know, is there is a deposit sweep network where they have a number of different participating banks. So for the purposes of this example, let's say that there's 4 banks participating. Let's say I have an account at bank 1 and I have $1 million that I want to deposit at bank number 1. But I only get $250,000 of insurance per bank. So what the sweep network does is they take the excess funds over 250 and then they sweep them out into the other 4 banks, and so I can get up to $1 million in insurance, and then all of my accounts and funds are insured, and that's great. However, in order to do that, we have to meet the formalities of the FDIC insurance at every single bank. And as we said, what typically happens is there will be maybe one big pooled account where everyone in the sweep program has their funds pooled in this one account. One of the banks will have some sort of custodial account that holds all that money. And then they have to keep records of every single person who has money in every single bank where those funds are held in that sweep network. So it's a bit of an undertaking, but it is possible. And now we're seeing quite a big increase in the use of these programs because companies can get tens of millions of dollars in insurance for their funds if they want to keep cash on hand.
Yeah, I noticed that also, like a lot of local municipalities, they've been doing more sweeping ever since that happened because small towns can't afford to lose their money. So definitely it's something that I think folks need to really learn about those sweep accounts and why they're so important and critical to maintaining the money over the $250,000 threshold.
Yeah, that's right. And the other thing too is not all sweep programs are created equally. So over that weekend, when we were wondering what SVB was going to do, we had clients come to us and ask, I have the sweep agreement. Am I okay? Where's my money? I don't think it's all at SVB. I think it's swept to these other banks, but I don't know. And unfortunately, some of the sweep programs didn't guarantee that the funds would even be swept into FDIC insured accounts. So it's really important in evaluating these sweep programs that it's actually swept into an insured account and not maybe some kind of uninsured investment account or uninsured money market account. There are types of sweeps that really don't guarantee that insurance. And so it's really important to read these agreements very carefully.
Well, thank you. That was very insightful and useful information. And so hopefully everybody out there is taking good notes because there's a lot to this. And you can definitely find yourself on the wrong end if you're not informed and well informed. So thank you so much to you both for that discussion. And I think, as one of the other things, the areas that I think has become very front of center of mind, and as we hear more and more things from the CFPB, is around dark patterns and folks kind of getting into the conundrum and getting stuck and not able to get out of, whether it's emails or whatever, but just knowing that there's so many opportunities for dark patterns to occur. Could you talk to our folks a little bit about some of the potential pitfalls with dark patterns and maybe some enforcement actions that have occurred in the last several months?
Sure.
Yeah,
okay. No, I was going to say whoever wants to jump in. Go ahead, Kim.
I was about to say whoever wants to.
Yeah, I'm happy to just do an introduction to the subject, and then Courtney can speak to the enforcement matters. I think that this is nothing new. This is something that we've seen from the FTC and the CFPB for many, many years. And there's been a particular focus on particularly whether the consumer believes they have signed up, they know that they have signed up and affirmatively authorized the opening of an account or the beginning of a service. And there's been, numerous enforcement actions over the years, and they keep getting more and more frequent, alleging that a financial institution or a company, not that they necessarily tricked the consumer into signing up, but that the flow was perhaps so seamless that they didn't understand what they were authorizing, or perhaps the consumer did have a good opportunity to read the terms and conditions, but a very important term about the cost of the service or what rights they were giving up to their data was buried on page 11 of 50, and the terms are presented in a link on your mobile phone. And that's just not something that anyone's going to read. And so
who reads this?
Right. And it at the end of the day, it's everyone's responsibility to read and understand what they're signing. But I think there's a line where the CFPB and the FTC are trying to draw, where at a certain point, the consumers really do need to understand the terms. And at the very least, they need to understand that they are signing up for a service just to begin with, and then they can look at the terms maybe later. So with that, Courtney, do you want to discuss some of the recent enforcement actions on this?
Yeah, sure. Happy to do that. Yeah, I think you can tell how interesting a topic this is, given that Kim and I both tried to jump in at once on this one. Yeah, and yes, there has been a good amount of activity in this space over the past year or so. Also not surprising, because just to intro the subject here a little bit further before jumping in and diving into a couple particular enforcement actions here in September. So September of 2022, the FTC had actually issued a report appropriately titled Bringing Dark Patterns to Light, where they focused on 4 separate dark pattern tactics that they were going to continue looking into over the past year. And that's kind of the impetus for some of this enforcement work that we're seeing. One of those dark pattern tactics that they identified was misleading consumers and disguising ads. So pretty much what Kim was just describing. And examples of that type of kind of tactics, so to speak, is ads that are designed to look like independent editorial content that actually aren't, or comparison shopping sites that rank certain items of a particular type of product, but it's actually ranked based on compensation that the companies have paid to that website. So making it appear neutral, like a neutral ranking site, when it's actually not a neutral ranking site at all.
Issue with like a lot of lead generators.
Right. Yep.
Yeah.
Exactly. And another type of like website tactic that they've identified is countdown timers that make the consumer feel rushed into making a purchase by feeling like they only have 2 minutes and 45 seconds left to press the buy button, or whatever the product is that they're seeking to obtain. The other identified area that the FTC noted was making it difficult to cancel subscriptions or charges. And then the third item is what Kim also alluded to, which is burying key terms or certain junk fees into customer disclosures. And then the last one is tricking consumers into sharing data. The FTC identified this as a huge area of concern. And just as a kind of tidbit here, the FTC had previously alleged that a smart TV maker had unfairly enabled a default setting that allowed the company to collect shared viewing activity and provide it to third parties after only providing purportedly a very brief and arguably buried disclosure that consumers might have missed. But kind of with that in mind, I'll mention a recent enforcement matter from just a few months ago. In June of this year, the FTC had filed a complaint against an e-commerce company for enrolling consumers in a subscription without their consent, and then by making it challenging to cancel. So right there, you have 2 of those identified tactics that it had previewed from its September 2022 report. It alleged that the company enrolled the consumers into this subscription service without obtaining any sort of consent or sufficient consent, while using arguably or alleged manipulative user interface designs that the company designed to deceive consumers into signing up for auto renew subscriptions when the consumers were not fully aware of what they were doing. This matter is pending, so we'll have to kind of see where it goes and how it navigates through the system. But this, I think the main takeaways here are, again, what Kim had mentioned, which is, ensuring that you have like clear and conspicuous terms, disclosures, fee disclosures in particular, easy cancellation processes for various subscriptions that don't require you to jump through many hoops in order to actually effectuate cancellation, or get so frustrated with the cancellation process that you perhaps just walk away from it altogether. So they want to make that a little bit easier for consumers.
Yeah, I think I've been victim of that. I had an instance where it was like I just couldn't even figure it out. So it took me like 2 months of relieving the frustration before I started digging into it again. So it could happen to any of us. So
absolutely. I think we've all been there at some point. Yes.
It's like, I'll just pay for 2 more months so I don't have to yell at my phone again. Kim, did you want to add anything into that from a compliance standpoint?
Yeah, well, there's a whole host of stuff here. So where to begin? I think the first thing is, on your sign up screen, making sure that it's very clear and conspicuous that the consumer is affirmatively checking a box and not just clicking continue and not realizing what they signed up for. The FTC has put out guidance on what they believe to be a clear and conspicuous disclosure and acceptance process. And that does include some sort of affirmative action, like a checkbox or something like that, affirmative acceptance by the consumer of the terms. If you have terms that are linked through a hyperlink and you're just scrolling through on your phone, it's going to be pretty difficult to read that, but they do have some standards around making sure that that link is clear and conspicuous. For example, we always use, you've seen the blue font instead of black to show that there's a link there. There's some guidance around the placement of the link. It has to be above where the consumer actually accepts it. And so you would normally see a checkbox saying, I agree to the terms and conditions, maybe the terms are linked, and then a proceed button right below that. So everything has to sort of make sense to the consumer so that they understand that they're actually signing up for the service. In addition to that, there are some types of recurring payments that require additional disclosure. So, for example, if you pay with your debit card, Reg E has certain requirements for authorizing recurring payments on a debit card. Those do not apply to credit cards, but I think, from a fairness perspective, there should also be a good understanding that the consumer is signing up for recurring payments on their credit card. How much is it going to be? When is that going to occur? How many payments are they going to authorize? And how can they cancel those payments? Or even just replace the payment method. So under Reg E, the consumer has a right to cancel their payment authorization. That doesn't necessarily mean they have to cancel the subscription, but maybe they want to change from their debit card to a credit card to pay for it. They do have a right to stop the payment on their debit card. In addition, the NACHA rules for ACH payments, there are very specific content requirements for authorizing a bank transfer by ACH. So if you've got a subscription or a recurring payment, and you have an individual consumer that's authorizing you to take payment monthly or weekly by ACH transfer, there's very, very specific content that has to appear on the authorization. And if you can't prove that the consumer authorized it, then that can be very easily charged back and reversed. And there's really not much you can do to dispute the reversal if you can't produce proof of that full authorization. When you do it through the ACH system, the technology system, there is a 60-day limit on reversing the ACH, but there's also a separate mechanism where the consumer can go to their bank, dispute the charge, and then the consumer's bank can ask for that authorization for up to 2 years after that authorization happened. And if you can't produce it, even if it's 1 year and 11 months later, if you cannot produce that authorization with all the requirements in it, you do need to refund the consumer. So it has a really big potential for losses, both to businesses and also to the banks. The banks are technically the ones that are on the hook under the NACHA rules. And, certainly the bank could try to go after the business for not having collected authorizations. It's probably a breach of their banking contract. But we've seen instances where businesses have gone bankrupt and the banks can't collect, or they're just, a general unsecured creditor in the bankruptcy proceeding. And so banks have lost lots of money because their customers haven't been collecting good authorization. So whether it's your customer or whether you're the bank that's, facilitating the payments, it's really important to get that process really compliant when you're authorizing subscription payments. The other thing too is for cancellation. California has a really strict law on subscriptions and cancellation. This isn't law everywhere. It's a very unique law in California, and it just doesn't exist in the rest of the country yet. But I think it does provide a really interesting model that you do have to comply in California, but everywhere else, If you don't follow those formats, perhaps it's not a direct violation of the state law in the state where this happens. But I think it does provide a roadmap for the FTC to argue that you've unfairly treated a consumer if you haven't allowed them to cancel. So I think, perhaps California is a gold standard and you don't have to do absolutely everything that California tells you to do in every other state. But I would offer that up as a good model for best practices in other states.
Absolutely. Absolutely. So before we get off dark patterns, either you want to add anything else in there?
I think I do want to make one more note about junk fees because that's been such a big focus.
Yes, please.
Yeah. So in the financial services sector in particular, we've seen really 3 types of fees that have been attacked in particular. And Courtney, feel free to chime in on any of these enforcement actions. But the CFPB put out some guidance pretty much attacking 3 different types of fees. One is credit card late fees. And there's some rulemaking proposals swirling around to reduce credit card late fees. Currently, they're set by Reg Z for consumer credit cards, but I think there's further action going on to reduce that even further. The bigger thing that we've been seeing, because this has been generating private class action litigation, FDIC, OCC, and CFPB actions, is overdraft and insufficient funds fees. This has been going on for a couple of years, and I think, the regulators have been aware of it for some time, but the plaintiffs' lawyers have really been aggressive and just going from bank to bank to bank and attacking the terms and conditions of the overdraft program and saying that they were not clear on when the overdraft fee or the insufficient funds fee would be charged. And they've been really successful at it, even where I thought that the deposit agreement was pretty clear. They've been incredibly successful in generating really expensive class actions for banks on terms that could even have a shred of ambiguity. And the most common type of claim that we see is where there's one transaction that generates multiple fees. Let's say that you authorize an ACH payment and it's for $100 and you have $75 in your account. That would probably be returned the first time for insufficient funds, and you would get an insufficient funds fee. And maybe you would expect to get one fee, that's fine, it's probably in your terms. But what people don't expect is that you can actually get up to 3 fees. And the reason for that is because the ACH rules allow the person who's charging your account to reattempt a transaction 2 additional times if it's been returned for insufficient funds. So on that first attempt where I had $75, it's going to be returned. Maybe the merchant's going to try again tomorrow. That's another fee that I can incur. And then maybe they're going to try again the next day, and then maybe that gets returned again as well. Or even if it doesn't get returned, maybe the bank pays it on the 3rd try, and then I get an overdraft fee instead of an insufficient funds fee. So you've got these situations where consumers are getting 3 fees on one attempted transaction. And, banks are aware of this and they've attempted to explain this in their deposit agreement. But the CFPB, plaintiffs' lawyers, and the FDIC and OCC have all started to say, well, this is a little bit aggressive. And so what we're seeing is a lot of banks reducing their practices for charging these fees. So we've seen a lot of banks just do away with insufficient funds fees and only charge when there's overdraft that's actually paid. Because there's a payment for using money that you don't have that's reasonable, but the banks are starting to do away with or reduce the frequency of insufficient funds fee. We're also just seeing banks limit the number of fees that can be charged. We have definitely seen instances where someone just mismanages their money, or maybe it's an older person who hasn't been able to take care of their affairs, and they just generate thousands of dollars in fees. And the CFPB has definitely been on those types of complaints and viewing that as unfair behavior.
Right.
And I would just note, kind of seizing on Kim's point about there being a lot of class action activity in the space, it's always the case that whenever there's a federal regulator consent order in particular, or state regulator consent order settlement with a company about a particular issue, plaintiffs' attorneys typically look at that, and you can expect, for the most part, class action litigation to follow. That also happens with respect to other similar financial institutions or companies. So, if there's like a consent order between the CFPB and company A, that doesn't mean company B is not at risk for class action litigation. Plaintiffs' attorneys absolutely look to other companies that might be doing similar type of work or activities to see if there might be something to bite off with respect to that company too. So just generally being aware of larger, more significant consent orders and settlement agreements with any federal or state regulator would assist your company to manage risk, or at least be aware of it.
Absolutely.
I would add one more thing to that, which is that the plaintiff's lawyers often beat the regulators to it and alert the regulators to the issue. So where the plaintiff's lawyer might be going down the line of banks, the FDIC will take notice that a bank under their supervision is subject to this action, and they'll jump on it. And that's not fun.
Not fun at all. Well, thank you both for that part of the discussion. I'd like to jump into expectations for enforcement for the rest of the year and even moving into 2024. Just looking at the data, the number of enforcement actions taken by the CFPB has decreased in recent years, but consumer relief is up. It seems like we are expecting enforcement actions to increase under Director Chopra significantly, but what do you make of this? Kim, would you like to start?
I was going to hand it over to Courtney, who has.
You want to go to Courtney? Okay. Well,
sure.
I was trying to be fair.
Thank you. Yeah, no, I was going to say that I don't think the numbers tell the whole story there. I think from what we've seen, there is a huge number of non-public supervisory activity amongst these agencies that's been happening behind the scenes, including in 2022. And it's that non-public supervisory activity that's going to yield more enforcement matters and more public investigations, enforcement matters that we all become aware of. So yes, while perhaps there might not be as many public matters, especially between 2021 and 2022 that we all expected, I think that, whether it's in 2023 or 2024, I think the non-public activity that we've seen in the past year and a half, 2 years is really going to kind of make its way to the public sphere.
I can see that happening, and I'm glad that you're saying that, because there's this false sense of there's not a lot going on over there in the CFPB, when in reality it sounds like there really is.
They are extremely busy, and we are extremely busy. Yeah.
Well, that's good to know. Kim, would you like to chime in on that?
Yeah, just one thing to add, which is with that background and broad brush, there's more specific focuses that the CFPB has, both for enforcement, but also supervision. So one of the things that we're watching really closely is the CFPB has publicly stated that they have a priority to focus on fintech companies, and particularly on buy now, pay later, earned wage access, and similar companies, which is really interesting to us for a couple of reasons. On the one hand, it's kind of expected because some of these companies are huge now. They're bigger than many of the banks. They're large public companies. They have a really big portion of the market share. And as many of you may know, the CFPB does take market share into account when it determines its supervision priorities. They really do look for how to get the most bang out of their buck. So it's unsurprising to see some of these companies wind up on their radar. What troubles me greatly is the fact that a lot of these fintech companies will actually offer their products by using banks that the CFPB has no jurisdiction over for supervision and very minimal jurisdiction for enforcement. So, for example, if you're a fintech company that offers a credit card program or a debit card program, most of those partnerships are offered by, well, not just the partnership, but the actual regulated product is offered by a small community bank under $10 billion. The reason for that is because banks under $10 billion are exempt from some of the interchange fee caps on debit cards, and they can generally be more profitable for these fintech companies to partner with smaller banks. However, the CFPB has no supervisory authority over banks under $10 billion in assets. And they have, I guess, sort of secondary enforcement authority, very little enforcement authority over these banks as well, because their primary regulator is maybe the FDIC or the OCC. And so I'm very interested to see how this plays out, because on the one hand, sure, the CFPB can go after the non-bank fintech company, but if the regulated product isn't even offered by them, they're going to have to be very careful in carving out which activity they're actually going to go after or supervise. Because if it's the activity of the bank, which they have no jurisdiction over, that's going to be a really tough road for them. That being said, there are plenty of activities that the CFPB could regulate for the non-bank fintech company. Advertising, as we've been talking about, is a big one. They can just use their UDAP authority to say that the non-bank company advertised this program and made false or misleading statements about it. That's a very easy way for them to go. But I think it'll be interesting to see if anyone pushes back on this, because at the end of the day, the product is offered by someone that they have no jurisdiction over.
Wow, that's very interesting. So outside of the CFPB, what else are you seeing? Maybe what about what's happening at the state level?
Yeah, I'm happy to jump in there on that point too. So one thing that kind of tethering or tying the CFPB discussion to what's happening at the state level. So as you may know, the CFPB often is, I guess, it doesn't have as many tools in its tool belt necessarily as other regulators. And so it tries to, at times, expand the tools available to it. And with respect to the states, while state enforcement activity has actually been down over recent years, we expect that activity to start to increase, because the CFPB had issued an interpretive rule that reinforced states' authority to actually enforce federal consumer financial protection laws in particular. So now state regulators are armed with enforcing the Consumer Financial Protection Act, for example, and its implementing regulations. And this interpretive ruling also permitted the states to bring and assert CFPA claims against entities that even the CFPB could not assert claims against, given its limited authority. And so, in part because of that, we do expect, and we have seen there to be an uptick in state regulator activity. There's a lot of state regulator activity behind the scenes with confidential investigations going on. And we expect that to absolutely continue and eventually make its way to the public sphere as well.
Wow. Very informative. Anything else we want to add before we move forward?
Yeah, I think on the state level, we're seeing a lot of informal inquiries as well, which maybe turn into public enforcement, but sometimes these inquiries will land on my desk on the business law side and compliance side first before they turn into public enforcement. And we are seeing an uptick in that, and we're seeing an uptick in it from states that are not usually considered the usual suspects. The most common types of actions we see are either false advertising UDAP type claims, but also licensing. And I think what the states are trying to do here is they're seeing the development of technology into, crypto, fintech. And a lot of these products are set up by, lawyers like us, who are really trying to carefully draw lines around the rules and figure out what is the product subject to and what is it not. And we're dealing with these old laws that maybe require licensing for one particular thing. A good example is these loan broker laws. And do they apply to somebody who markets a credit card program that's actually offered by a bank? If you build the app, you take the application, you help the consumers get the loan, there's enough there for some of these states to come after these fintech partnerships and say, well, the fintech partner should have been licensed as a loan broker, or maybe they're involved in servicing and collections. That's another way. And so what we're seeing is the states have enough information at this point about where the state of the industry is. We've been in this fintech and crypto world for quite a few years now, and I think they've finally grown wise to how these are set up. And they're thinking about ways that they can assert their jurisdiction to protect consumers in their state. And so we're seeing a lot of licensing inquiries, and we're seeing a lot of advertising inquiries, just from a general UDAP perspective.
Absolutely. So from the marketing compliance perspective, based on all the things that we were discussing today, what are some of the best practices and strategies that you would offer to those that are listening in, things that they can do right now to get their compliance programs in order?
Yeah, happy to mention a couple and then kick it to you, Kim, if that works. I would say, going back to some of the initial enforcement actions that we were talking here with respect to potential discrimination claims and making sure that you have, not only robust compliance programs, but those that oversee marketing endeavors of the company to ensure that, you're marketing in, assuming this applies to your company, in both minority and majority neighborhoods, communities, et cetera. Make sure that you're monitoring for that. And then I think data monitoring is always helpful to do. Most compliance programs have some sort of data monitoring compliance aspect, but I would say being aware to the extent feasible of what peer companies are doing as well with respect to their advertising always helps too. It's never or it's not considered a best practice to say, well, just because my peer is not doing something means I don't need to do something. That's not an argument that ever bodes well with regulators or courts. But at least like knowing whether you're in the market average is helpful to assessing compliance risk in that area.
Absolutely.
I think from the beginning of all this, I was an examiner at the CFPB from the early days. And I remember on my first exam, I didn't know anything, but we zeroed in on the process by which the bank was conducting its marketing reviews. And we noticed holes in who was reviewing what. And maybe there was a circumstance where something was initially approved by someone in compliance, but then maybe it was changed and not run back through the process. The other thing too is understanding the scope of the items that need to be reviewed. We've seen companies get in some hot water with the regulators, not necessarily from the usual marketing or the website, which underwent perfect compliance review, but then someone wrote a blog post and made some statement that wasn't necessarily untrue, but it was written in a imprecise manner because it was a blog post. It was supposed to be informal, and that has generated attention from regulators. So I think it's really important to look at your process and make sure that there's a clear process for who approves what and when, and that there is an approval at the last step out the door, including for anything that comes back for any sort of edits, understanding the scope of your procedure. And then also, I think in the world of vendors and partners, and these fintech partnerships, there's a lot of fighting around, how to divide that responsibility between the bank and the fintech partner. So I think at the end of the day, whoever is actually offering the product under their charter or their license is the one that needs to be responsible for all of that. And what that means for their partner who might be directing the marketing activities is that they need to run things through the bank or through the licensed company that's offering it. And I know that is such, the bane of their existence sometimes, especially for some of these smaller, nimble startups who want to go a million miles a minute. But it's a really important process because something so small on their website could really generate a lot of problems. And so, again, going back to process and making sure we understand the scope of the materials, the scope of the people that have to come to who for approval, and just generally having that plan in place.
Absolutely.
And it also,
oh, go ahead. I was just gonna chime in too, but go for
oh,
it.
I didn't mean to interrupt. Go ahead.
No. I was just, one of the things that kind of sits with me just from the past I had in the marketing compliance space was the importance of the ongoing monitoring and just being on top of, it's not just approved and done, that there has to be a process in place for that ongoing monitoring, because you don't know what could change up on a website. You don't know what could change up on social or anywhere. So just being vigilant about, staying on top of the ongoing monitoring and documenting any changes.
And maintenance. So if there's ever an unfair advertising claim of sorts, then, and if it makes it to, the court system, there's a lawsuit, regulators absolutely will demand the data or documents supporting advertising statements, including those made on your own website or your vendors' websites. And so making sure that you have data or documents supporting current statements that are on websites, ensuring and monitoring your vendors or any sort of third-party affiliates, website statements, marketing brochures that perhaps advertise your company as well, to ensure that those statements are accurate. That's something that needs to be done as well.
Totally agree. Totally agree. So as we are coming up to the top of the hour, I just wanted to thank you both. But before we leave, I wanted to give you at least an opportunity, if you had any additional last minute thoughts, any additional nuggets that you would like to share that you maybe didn't get a chance to get out there. But I feel like we had such a great discussion here. So much good stuff. But I definitely would like for you to feel free to have a closing thoughts.
Yeah, first of all, thank you for having us. Really appreciate the opportunity to engage in this discussion. No, I think our main takeaway is, ensuring that there's a robust compliance system, and completely understand also that with respect to startup companies, as Kim mentioned, kind of move a mile a minute, but having a designated employee who's at least starting to monitor that stuff is really helpful, especially in the new company space.
Appreciate that.
Yeah, absolutely. And then just to move back to the monitoring piece, I think, making sure that there's monitoring, not just on, the website and marketing, but monitoring that the procedures and processes that you have in place are being followed. Because as Courtney said, the regulators will come back for proof of compliance. And, even if you follow the law, there's a concept of a policy violation where if you're not following your policies, even if your policy went above and beyond, that is an important thing that regulators look at as well. So overall, having a process that makes sense and is realistic for your organization is really important.
Totally agree. And thank you so much for those closing thoughts. Once again, thank you both for such an informative discussion. I'm sure that everyone out there is busy taking notes so that they could take advantage of the great information that you all shared so that they can improve their compliance programs. And always feel free to reach out to us if you would like to connect with either Kim or Courtney in their business areas, if you feel like they can be of help to you. And as always, PerformLine is also here to help you. You can always reach out to myself or go to our website and click on the demo form and arrange for a demo of our product. And just for those that are out there that are going to be traveling in the coming months, attending conferences, you can catch up with our PerformLine folks in person at the following events. October 15th through 18th, I will be in Philadelphia for the MBA annual convention. And then October 22nd through the 25th, our team will be at the Money 2020 conference in Las Vegas. There is going to be a meetup session on Tuesday, the 24th at 11:30, and you'll have an opportunity to talk and connect with our team, John Zanzarella or Alex Morris. You can reach out to them on LinkedIn in advance. And also in October, ITC InsurTech Connect. We're going to be in Las Vegas. Carrie Ann Gilmartin will be attending on behalf of PerformLine. And the November FedFizz Roundup, that's going to be in Fredericksburg, Texas, November 1st through 3rd. And we are a sponsor of this event. And with that said, again, we thank you all so much for joining us and participating in today's webinar. Kim and Courtney, it was a great discussion. I hope we have an opportunity to do this again. I love talking about enforcement actions and hearing all the great things that are going on that you guys are doing over there at Goodwin. So again, thanks so much for being a part of today. And thank you everyone for joining us for today's webinar.